Alrighty, folks, we have heard from Jerome Powell. We are seeing on the Fed Watch tool that interest rates, the Fed rates, are not going down this year until best case the summer and quite possibly September. Your boy here still thinks they're not cutting all year, but hey, we'll see what happens. What I want to talk about today is something more meaningful if you're in the real estate game. We shouldn't be worried about what the Fed's doing. It doesn't control mortgages. What we should be talking about is, Michael, how can we get the spread between the 10-year note and the 30-year mortgage back to historical averages? If you don't remember, historical averages are about 180 basis points. Today, we are running right around 260. So there's 80 basis points that could be collapsed just to get back to where historical averages are. That is what we should be talking about. And that is the question for Jonathan from Convoy Home Loans. Jonathan, do you think there's anything we could do in the near term, call it 2025, to see the spread go in the right direction?
Anything we can do physically? No. Right?
Fair enough.
There's
Fair enough.
there's nothing that I think people don't have control over this, kind of situation. But I think one of the things that obviously they're watching very, very closely has always been the inflation marker, right? And I
Yeah.
think that if inflation, which realistically from a chart level, we're still lower than where we were, obviously. But
Mhm.
if we see kind of jobs obviously come out not as strong, we see actual real economic data that I think I say real because I think a lot of this data that comes out, it doesn't match what's actually happening, on
Mm.
the streets, like actual streets. Once there's a little bit of correlation there, I think that spread will have to come down a little bit and break in between so that we're back to normal levels. Because I think there's a huge gap, and I think that gap is caused by there being a huge disparity between what's real
Mm.
and what's actually happening.
Really? Yeah.
Yeah.
What's reported and what's real. It's interesting. So I actually have two thoughts. And again, you're in the business. So I wanted to run these by you because I'm just some guy that looks and reads all the time. So the first thing I think about is, and again, you've brought me a lot of this stuff. You and your partner, Dustin, are constantly finding new products and new ways to help people, which we'll talk about in a minute. But what that taught me is uh, competition's a good thing. And also, there are times where the market is hungry for loans. So the first thing I think about is if we do really see 2025 going the way I anticipate, where 2025 is worse than 2026, that leads me to believe there might be a lot of starving lenders who then may take haircuts, margin compression, just to get incremental deal flow coming through. So one way to see the mortgage spread collapse, in my opinion, is simply less transaction leads to competitive behavior, leads to collapse in rates. Does that tie, or am I missing something?
I think that's, I mean, physically speaking, correct. I think in order for that to happen, though, there has to be, because the margin in terms of actually selling these loans, right, and making a profit on these loans, um, is largely dictated by, we're not talking about Fannie Freddie, I think,
No.
for the most part, because Fannie Freddie has its own market, it has its own thing. So if we're talking about non-Fannie Freddie type loans, um, I think they have to see an overall stability in the market sense because they are baking in still their margin for risk, right?
Sure.
Um, a lot of these lenders that have gone out, like in terms of like not closed doors, like you're talking
Yep.
about,
Yep.
tightening the margins and whatnot, a lot of that has already happened, right?
Mm.
So what I think now is a lot of those people that were squeezed out have been squeezed out.
Okay.
And now that there's a little more normalcy in the market, I'm actually seeing lenders react a little better in the sense of little less more aggressive, sorry, on the terms.
Okay.
Um just purely because there's a little more of a, they're trying to create transactions
Right.
by lowering margins versus before where they had to bake in the risk. So I
Okay.
think that's kind of, a stabilization in the market a little bit, right? It's crazy to call this a stabilization, but we haven't seen it go up or down like crazy. So
Yeah.
technically we've seen it be a little stabilized. And I think that made the risk kind of, that's going to continue to make the risk factor come down a little bit, in which case, the biggest thing is they have to worry about selling these loans off if they're bad loans, right?
Right.
And if they get defaulted and whatnot, and if that happens, they have to sell these loans on pennies on the dollar. So they always have to bake that in. As that risk comes down, I think we'll see, like you said, the margin compression come down a little bit.
Yeah, the other thing that I was thinking about is, again, when I go back to the question of why did the margin get so fat? And again, I think the fattest I saw was 309 basis points. I think a lot of that was because of refi risk, right? A lot of lenders were doing these loans and really going, "Oh my God, rates are going to fall quickly, and I don't want to get refied out and really take a loss on this." So that's why margins got fat in the beginning. And so if that's true, and I'm not saying it is, but it's just my opinion, the longer we stay at 7%, the more they're going to believe that refi risk is not real, or at least less. How does that tie together?
It's interesting you say that because I was looking at and talking to some clients that we're done deals with over the years, and um, our rates now, right, in terms of the yields, we're still pretty high, right, in terms of like where we are versus where we were 3 years ago.
Mm.
Just looking at chart wise, but our rates today are lower than the same position we might have been last year in
It's fun.
this same market,
It's
right?
funny you brought that up. That was my
Yeah.
next point.
Yeah,
And
it's it's wild that we're seeing that parallel kind of happen, where that margin shrink we're seeing happen. But I think it's because my thing, and this is just talks with secondary markets and such.
sure.
It's
Mhm.
purely because they've seen a little more stabilization in terms of I can finally draw a line straight through
Right.
without worrying that it's gonna break up or break down in a crazy level.
Yeah, and that's actually my third and final point before we get into new products you're bringing to the market is the consumer. And I want to shout out Lance Lambert Resi Club for this. He posts this every day now, which is awesome. I'm going to go from memory. Yesterday's mortgage rates were 7.07. This again is conventional owner ox stuff. Last year, this time, they were 6.97 or 6.98. So basically, to your point, we're now flat for a year. So what I think is going to happen very quickly with consumers is they have short-term memories. And there was a time when rates were going like this that they're like, "Oh my God, I remember 4, so 5 sucks. Oh my God, I remember 5, so 6 sucks." Then there was a time where they remembered 8, so 7 was good. Now we're at a point where 7 is 7. And if we stay there another 6 months or so, 7 is 7 is 7. They're going to forget that memories of sixes and fives, and they're just going to start to transact. What do you think of all that? Just rates being stable for longer is a good thing.
Yeah, and we've seen it happen across the board in terms of transactions going up still. Not like a shoot up, but anyone that's trying to do work or do the work or do transactions is going to start coming out of the woodworks and start to do the
Yeah.
transactions. So I think the stability of the rates is, and I think we've talked about bad news, short-term memory for a lot of consumers. People forget that um, where we were in the last 4 years ago now is not historically normal
Correct.
to where we will be in a normal market.
Right.
So, anyone that's hoping for rates to go back down to there, which because I've had actual conversations with clients saying that, is I tell them, hey, I really don't think that that'll be the case. The market is not going to support a decrease down to the levels we were at 4 years ago, right? You have to almost forget about that. Everyone has short-term memory unless they've been in the market for that whole time, and then they don't have short-term memory because they look at their mortgage statement and it says 2.75 or 3.25, and then they're like, oh well,
Oh,
you know, I see it. Yeah.
yeah, yeah. It's going to be wild. So again, I think what we're going to see hopefully in 2025 is, again, what I keep calling the last hard year. Things start getting better in 26, 27 is better than 26, and so on. I think we have a decade of growth ahead of us after we get through 2025, which hopefully is starting to feel like a good feeling for folks. I do know that 2025 is going to be rough for a lot of people in real estate. But let's get to some new products. You just rolled out a brand new product, sub 8% for experienced flippers with a pretty crazy high loan to cost. Why don't you tell us about that product?
Yeah, so we have a new fund that we partnered up with on the Bridge product. This is the short-term loan, so I have 12 to 18 to 24 months on rehab, right? Purchasing plus rehab, kind of like the deals that I use and a lot of people use to take advantage of as is properties, value add properties that need some work, do the work, and then refinance after based on the ARV. So we have a new product. Minimum loan amount is 250,000, but it's at a 799 on a 12-month interest only without a prepay. And it goes up to, if you're super experienced and it's a light rehab, depending on how hard the rehab is, anywhere between 85, 87.5 to 92.5% loan to cost.
92.5 potentially.
It's crazy because I'm seeing now, and this is, sorry to go backwards a little bit,
Okay.
but talking about our margin compression and just like the comfortability of the lenders, right, as being a main factor. The reason I said that, as seeing market stabilization, and that's the biggest factor why,
Yeah.
is we are in the same market again, basically that we were in last year, and
Yes.
the last year the highest leverage that you could average get on these bridge loans was 85%, right?
Right.
Now we're looking at these funds open back up, and now all of a sudden you can get 92.5, right? And
Nice.
sometimes even 93, right? So I'm starting to see these start coming out, and I'm saying, okay, we're basically in the same market, but the rates are lower on the bridge loans.
Yep.
And also on top of that, the leverage is higher. So people are obviously seeing in secondary markets. I like to think most people are smarter than me, just because this is all they do.
That's all they
Um,
do. Yes.
yeah,
All they do.
and they're seeing that the market is going to be a situation where you're 799 and you have all this new opportunity to kind of make more transactions happen. They're really just trying to aggressively pump things in.
No,
Yeah.
this is exactly what's happening. You know what's really interesting? This happens all the time. You know, if we step back in the clock and go back a couple of years of the time machine, there was a lot of flippers who frankly sucked at their job but got lucky. Those people are now gone. So what you're left with today is experienced flippers. And I bring several of them on my channel all the time who are rocking and rolling. Maybe they had a couple of bumps in the road in 23 Q1, which sucked for everyone, but they're still in business. They're still doing deals. They're still buying for better. Adrian Hernandez getting more deals. Jason Pritchard getting more deals. Omar getting more deals. The guys that are hitters are going to crush it in 2025. All the pretenders, they're back to being baristas and, you know, waiters and dishwashers. So it's pretty funny. Next, let's talk about DSCR loans. You now got some products with a par of 6 3/4. What the heck are you talking about?
Yeah. So again, same market we've been in, but we've been talking about a little bit of stability in the market, and we're seeing it even though with the market move yesterday. I just priced one out this morning. It was 25% down. And I like to be sensitive to a lot of clients on the channel that are $150,000 loan amount and below.
Right.
Those under $150,000 loan amount, they're starting to be a massive hit for those smaller loans.
Yeah.
Anything above $150,000 loan amount, like that's the audience I'm talking to right
Yeah.
now.
So that's,
Which
just to be clear, that's the loan amount, not the purchase price.
correct. So price that one this morning, 25% down. It was a $250,000 loan. The starting rate with a 4-year prepay was 675
Yeah.
without buying it down. And then to buy it down to a 6499 was like I think it was like 0.75% on the
So
buy down.
less than a point. Okay.
Yeah, so it's like we're in a position, I think now, which is what we have always told clients. If you like it, lock it, just move on and because just continue to do the deals, right?
Yes.
Don't wait for Big Daddy Trump or Big Daddy Powell to really bring the rates down. Just do the work right now. Rates are great. I mean, we're talking six handle,
Yeah.
right? And for most people, if you go from 675 or 6499 down to like 6%, like let's say rates drop to 6%, which means that, by the way, primary rates are a percent lower, right? Which means primary is like 5, touching the 4s on
Yeah.
FHA stuff. So, we're in a good position. Like the payment difference is not that much.
Right.
So you might as well continue to churn the deals while, the rates are kind of in a position where it's at.
No, again, if you're an investor, you love this environment. Your competition has disappeared. Buyers are gone. First time buyers are out. We get to go fish for motivated sellers. You know, there was somebody on my channel yesterday, Owe and Ann. Actually, I think it's 2 days ago now. They bought a fourplex. I think it was initially listed for 425. After a year of following and follow up and all of that, they bought it for 242.
Wow.
I don't give a rat's ass if it's 7% or 8% money. It's going to make sense at that number. So again, do the work, follow up. It's never easy, but consistency, discipline wins. Any other products you want to talk about as we wrap this up?
Yeah, so a lot of people are forgetting, but 1 to 4 units on DSCR, you can still do 20% down as long as the debt covers.
Oh, wow.
So 20% down is still a thing. Pricing's not terrible either. We're talking like 20% down, amazing credit. Again, over the $150,000 loan amount, right? We're talking 69971.
Okay.
So
Nice.
still a pretty good. If your target is cash on cash, that 20% down is key.
Can make a
Is the
difference.
way
Yeah.
it's where I tell the clients, like, especially if you're talking about a smaller loan amount in the 200-ish range,
Yeah.
like that extra 5% of 10 grand, you could probably put that towards the down payment of a new property if it's only
Yeah.
going to make a difference of like, $100 on the actual cash flow, you know.
Correct. Yeah.
Um, but the last product that we wanted to go over, which is kind of a big deal, is now we can do actually 85% LTV, so 15% down,
Oh,
DSCR
wow.
loans up to $1 million. Rates are not pretty, right? And I don't think anyone expects it to be. But if you're buying it with 15%, I'm hoping that you're buying it with such amazing cash flow that
I hope so.
the yeah, that you're at 15%, you shouldn't be looking at 100, just 1-to-1 DSCR. I think at 15% you should be looking at 1.25,
At least.
1.2
Yeah. Yeah.
at
Yeah.
least, just to protect yourself from the shift in valuation that can happen from putting such little down.
I agree.
So rates are going to be in the eights to nines, like hot mid eight-ish is what I priced out yesterday. It was like 8.5 on 15% down single family residence with
Hmm.
like excellent credit and a 3-year prepay. So it's not bad, right? And
Yeah.
then if you go into like a 1-year prepay, which if you're doing 15% down, I would probably recommend a shorter prepayment penalty than a longer.
Sure.
But if you're doing a shorter prepayment penalty, I saw as is like 9.25, which again, if you're doing 15% down, you're not looking at your focus should not be what is the rate, but it should be what is the payment and can I make it cash flow at a
Yes.
good enough percentage so that I can make up for that 5% difference in the down payment that I could have made to protect my equity. Because 15% is not that much of a swing, especially in the investment world.
Mm-hmm.
Like that can be gone, depending on what happens in the local market.
Yep,
Yeah.
absolutely. Well, the beauty of what Convoy, you and your partner Dustin bring to the table is you're always out there looking for more and more options. You are investors yourself. You've shared with us what you're doing in Koreatown down in Southern California. So it's amazing to have you on the channel. We are going to see you this weekend. But if somebody wanted to reach out and see what's going on with Convoy, what do they do?
Go to convoyhomeloans.com and let us know you came from ORAT.
Yes, folks, there's a little drop down window. Tell them you came from ORAT. So you get this young man or his partner, Dustin, because if you don't do that, you just end up in the queue. You don't want to be in the queue. Don't go to the queue. That's just foolish. Thanks, buddy. See you this weekend.
Thank you.